When it comes to market dips, what do people tend to do? They'll have some fear and they may sell. Now, before you sell your stock and you hit that sell order, there's a few things you need to know. In this video, you're going to learn why timing the market might be a really big mistake and you could be playing with fire. So I'm going to share with you why and how you could take advantage of when markets become compressed. You know, over the past 2 decades, I have guided families through this very topic. Just a few weeks ago, I had somebody come to me anxious about the markets and what they should do regarding it. So the biggest reason for people pulling out of the market is fear. And I totally understand it. Trying to time the market is very difficult. And you have to be right twice. You have to be right when to get out and when to get in. And that is very difficult to do. And since none of us have a crystal ball, we need to understand how these mechanisms work, most importantly, how they impact you. So let's take a look at this chart. Take it into consideration that we invested $10,000 in 2003. If you just let that money sit for almost 2 decades, your $10,000, you'll see, grew to over $65,000. Pretty good result. Now that same $10,000 invested during the same time, if you missed the 10 best days of the markets, your 10,000 now only became 29,000, half of what it would have been. Missing the 60 best days in that 2-decade period, your 10,000 shrunk to $4,000. By the way, do you know when the best 10 days were? It was all during a bear market. And if history has taught us anything, it's that every bear market has recovered. The difference between 29,000, 4,000, and the large balance of 60+ thousand was a disciplined approach. Making sure that you're positioned to deal with the market's downturns is just as important as investing. The way we make sure that people stay disciplined is we meet on a regular basis, and education will keep them on the right path. Understanding their plan is not built on just 1 day, 1 week, 1 month, or a few months. It is built on future planning. And as changes need to be made, they're made strategically. That's how you stay in the right approach. So if you feel like the sky is falling and everything around you is falling apart, and the approach you're taking is not a good one, I want to caution you on the advice that you're getting. It should never be a cookie cutter approach. So I know people want answers immediately, but not every plan is applicable to the person. So there's 2 approaches. Giving you an example of this. One person may not have an income need at this point. They're not spending as much. The other wants to spend more. Their plans should not be the same. How do you take advantage of market downturns? You make sure that the advice is ongoing so that you take advantage of potential Roth conversions. Now, I'm not saying go out and do Roth conversions. It needs to be customized and done efficiently based on multiple factors. Otherwise, you just have a cookie cutter approach. I personally love helping families solve these challenges. My calendar is linked below for you to take advantage of a 15-minute strategy call where you'll get no nonsense, straight to the point answers on how to best improve your retirement. We know there's no do-overs in retirement. Getting it right the first time will prevent a lot of headaches for you into the future. That involves getting the right advice and making sure you understand the moves that you're making and the consequences of them moving forward. I look forward to chatting with you soon.